In this video, we will discuss the math behind profitable trading and how every single trader uses these concepts to have an equity curve, just like in the green example. And if you are currently not profitable, then the concepts we will discuss in this video will definitely help you out. One really important term that you need to know in trading is expectancy. Expectancy is the average amount a trader can expect to make after a series of trades. Every single trader has an expectancy. It is the math behind your trading. And here is the formula we use to calculate the expectancy. So expectancy is your win rate times your average win minus your loss rate times your average loss. This might seem complicated, but trust me, in just 2 minutes you will know everything about it. So let's take a look at some examples. Here we have the expectancy of trader A. You can see that he is clearly a losing trader and thus his expectancy is negative. Somewhere in your trading journey, you must have been here, and so have I. And no matter what you do, you just simply keep losing money. And it's not because the market is against you, as many traders might think, but it's actually because the math behind your trading is just completely flawed, just like in this example. Because you can see that his risk to reward ratio is a 1-to-1. He takes around 30 trades a month and his win rate is 40%. And finally, he risks $100. So if we take all those important variables, after 1 month of trading, we have 12 wins and 18 losses. And to calculate his expectancy, we take the total amount of wins, which is $1,200, and the total amount of losses, which is $1,800, and this gives us his expectancy, which is $600 in negative after 30 trades. This is what the math behind losing traders looks like. Now let's take a look at the expectancy of a winning trader. This trader does everything the same as the losing trader, but the only difference is the risk to reward ratio. And it's not magic or some secret indicator, but just the risk to reward ratio, which is different. And this trader clearly takes full advantage of his winners. His winners are 3 times bigger than his losses, so even with a 40% win rate, he consistently wins. So let's take a look at his results after 1 month. Just like the losing trader, he has 12 wins and 18 losses. But his 12 wins total 3,600 and his losses only 1,800, which gives us a total profit of $1,800. Do you now see the simple math behind a profitable strategy? This is extremely important to understand because if you understand this, you start on the right foot. Instead of looking for a shiny strategy that doesn't work, you now have an understanding of positive expectancy and how important it is. One thing I implemented in my trading and had a real positive effect is having a fixed risk to reward system, because nothing is worse than having to guess where to put your stop loss or take profit. Before I implemented a fixed risk to reward, I would always look at my trade and think I could have held a position for 1 more day and made X, Y, and Z amount of money, etc. But that is looking at trading like gambling because you're trying to hit the jackpot with each trade. So what is a good risk to reward ratio? Personally, I like the 3-to-1 risk to reward ratio because in this case, 1 win is equal to 3 losses. So if you just win 1 trade and lose 2 trades, you are still profitable. And those are extremely good odds. Here we have a chart where you can see the win rate you need to break even for each risk to reward ratio. You can see that with a 3-to-1 risk to reward ratio, you are guaranteed to be profitable when your win rate is above 30%. And let me tell you, being right 30% of the time is not hard at all. So if you are not sure which risk to reward to use, go for the 3-to-1. The 2-to-1 can also work, but the wins are just 2 times bigger than your losses, so your win rate needs to be high for it to work. And one extremely important fact that you need to know is that the higher your risk to reward ratio is, the lower your win rate will be. And nothing in my 7 years of trading is more frustrating than taking 5 or 10 losses in a row. No matter how long you've been trading, once you're in such a losing streak, it becomes hard to follow your rules and you fall victim to your emotions. And this can have catastrophic consequences, so it's better to go for a high win rate strategy with a lower risk to reward ratio, just like I have, because my win rate is between 50 and 70%. If I had to really give you a number, it would be 60%, and my risk to reward is 3-to-1. So let's take a look at this example here. You can see that this trade was a winning trade but turned out to be a loser or in the best case scenario, a break-even trade. This was a 3-to-1 trade, meaning it would have gone to your take profit if it was at a 3-to-1. But if you were aiming for a 5-to-1, then this trade would have turned out to be a loser or a break-even trade. This is obviously just one example, but from years of experience, I have noticed this pattern so often that when you try to aim for an extremely high risk to reward, that oftentimes your winning trades turn out to be losers and your win rate is extremely low, and it can get very frustrating. I like to call this concept the cost of missing out. Since no one can execute a strategy or a system 100% correctly, you are destined to take unnecessary losses and even at times miss out on winning trades, and it can have detrimental effects on your performance. So here I decided to use the 3-to-1 risk to reward ratio, and you can see that out of the 10 trades we won 5 and lost 5. So our total losses equals 5 times our risk, which is minus 5R, and our wins total 15R, so totaling 10R in profit. So if we traded our strategy 100% correctly, this would have been our result. But now, let's add a realistic twist and say we took one loss too many and missed out on one win. You can see the extra loss in blue. This used to be a winning trade, but we missed it. After this mistake, we still walked away with a profit of 6 times risk, or 6R. Now, for the sake of the example, let's say we made another mistake and took 2 unnecessary losses instead of those 2 wins. Our total losses now equal 7R and our 3 wins total 9R. So in this case, where we messed up badly, we still walk away with a profit of 2R. So we took 7 losses out of 10 and still walked away with a 2R profit. This is the power of understanding the math behind your trading. So what I want you to do now is to get yourself familiar with an equity curve simulator. This is a tool that's extremely important to use. Like it's going to be way easier to become profitable once you get familiar with this. And the website that I use is iondo.com. I have put the exact link to this tool in the description and it's completely free. But let's go ahead and use it. So for start equity, we will put 10,000 just for the sake of the example. Our win rate, let's just say 30%. Our risk to reward ratio, 3-to-1, number of trades, let's just put 100, number of lines 1, so that's the amount of simulations that I will run. So right now we have 1, but if I put 50, it's going to run 50 simulations, and then it's going to give you the average. And the way I use this is that when I'm working on my strategy, right, I like to first put it here before ever trading it. So for the last 2 years when I have been testing a lot of strategies, etc., I would put them here, the metrics. So let's just, for the sake of the example, say it had a win rate of 40%, the risk to reward is 30. We are going to test this on 100 trades, and let's just run one simulation risking 1%. Oh yeah, I think that's 1%. You can see that this strategy is extremely profitable.